There is a document on the FDIC's own website. It is titled Resolution of Systemically Important Financial Institutions, the Single Point of Entry Strategy. Most Americans have never heard of it, those who have rarely read past the first page. But if you study it carefully, you will discover something chilling. This is not a plan to protect depositors. It is an operating manual for how the government will convert your savings into bank equity to prevent a systemic collapse. It describes, in bureaucratic language, the exact mechanism by which your cash will be seized and transformed into something else, something you cannot withdraw, something you do not control. The document is public, the system is legal, the infrastructure is active. And if you think this could never happen in America, then you have forgotten what happened in Cyprus on the 16th of March 2013. Here is the paradox that should terrify you. Officials at the Federal Reserve stand before cameras and tell you that inflation is under control, that the banking system is sound, that your deposits are safe. Yet, behind closed doors, the Bank for International Settlements, the central bank of central banks, is publishing detailed blueprints for a new monetary system built on central bank digital currencies. These are not upgrades. They are replacements. The BIS documents describe a world of programmable money, where your spending can be tracked, restricted, and expired. They describe a system designed for total control. So ask yourself this question: why would they build a replacement system if the current one is stable? Why construct a lifeboat if the ship is not sinking? The answer is simple. They know what is coming. They are preparing for it. And they are not preparing to save you. By the end of this documentary, I will show you three things. First, the exact legislation that makes a mass wealth seizure legal in the United States. Second, the technology that makes it possible to execute instantly across all 330 million Americans. And third, the historical pattern that proves this is not a matter of if, but when. This is not theory. This is not speculation. This is infrastructure. And the protocol is already active. Let me take you back to the night they stole Cyprus. It was March 15, 2013. A Friday evening. Banks across the island nation were preparing to close for the weekend. The economy had been struggling for months. Greek debt exposure had crippled the financial system. But the government assured citizens their deposits were safe. That night, European finance ministers gathered in Brussels for an emergency meeting. By Saturday morning, the decision had been made. Every bank in Cyprus would remain closed, not for a day, not for a weekend, but indefinitely. When Cypriots woke up on Monday, they discovered that their life savings had been seized, not by thieves, not by hackers, but by their own government. Citizens with deposits above 100,000 euros at the Bank of Cyprus saw 47.5% of their money forcibly converted into bank stock. Not cash, not bonds. Stock in a failing institution that would become worthless within months. This was not a glitch. This was not a temporary freeze. This was a bail-in. The term itself was unfamiliar to most people at the time. A bail-in is the opposite of a bailout. In a bailout, taxpayers fund the rescue of a failing bank. In a bail-in, depositors fund the rescue. Your savings are converted into equity. You become a shareholder in a collapsing institution. And you have no choice. The Cypriot government called it an exceptional measure. The European Central Bank called it necessary. The International Monetary Fund called it a template. That word should haunt. A template. Not an accident. Not a one-time emergency. A model to be studied, refined, and replicated. The global financial establishment did not condemn what happened in Cyprus. They took notes. Within months, the Financial Stability Board, the regulatory body that coordinates policy for the G20 nations, released a framework titled Key Attributes of Effective Resolution Regimes for Financial Institutions. Buried within it was the endorsement of bail-ins as the preferred method for resolving failing banks. The message was clear. The era of taxpayer-funded rescues was over. The next crisis would be paid for by depositors, and the infrastructure to make it happen was already being built, not in Brussels, but in Washington. In 2008, the American financial system came within hours of total collapse. Lehman Brothers failed. AIG was on the brink. The commercial paper market froze. The government responded with the largest bailout in history. The Troubled Asset Relief Program injected $700 billion of taxpayer money into the banking system. The Federal Reserve expanded its balance sheet by trillions. The public was outraged. Protests erupted. Politicians promised it would never happen again, and they were telling the truth. It will never happen again. Not because the system is safer, but because the next time you will pay for it. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was over 2,000 pages long. Most members of Congress never read it. But buried within Title II is a section called the Orderly Liquidation Authority. This is the legal foundation for bail-ins in the United States. The language is dense, deliberately obscure, designed to avoid scrutiny. But the meaning is clear. When a financial institution is deemed systemically important and on the verge of failure, the FDIC is granted the authority to seize it and impose losses on creditors. That includes shareholders. That includes bondholders. And that includes depositors. Because under law, when you deposit money into a bank, you are not storing your property. You are making an unsecured loan to the institution. The bank owes you a debt. But in a liquidation, unsecured creditors are last in line. The FDIC's own resolution documents confirm this. They describe a process called single point of entry, where a failing bank holding company is placed into receivership and losses are imposed on creditors to recapitalize the institution. Your deposits can be converted into equity, into stock, into a new form of liability that you cannot withdraw. This is not a secret plan. This is public policy. The law was passed. The framework was published. The system is operational. Now let me show you why this system will be activated. The United States is walking toward a fiscal cliff that cannot be avoided. The national debt exceeds $34 trillion. The debt-to-GDP ratio has surpassed 120%. Historically, this is the threshold where sovereign debt crises begin. Nations that cross this line face a choice: default, hyperinflation, or confiscation. The U.S. government is not going to default. That would collapse the treasury market and destroy the dollar's reserve status. Hyperinflation is politically unacceptable. That leaves one option: confiscation. But the scale of the problem is so enormous that traditional methods will not suffice. The federal government now pays more in interest on the national debt than it spends on national defense. This is a mathematical death spiral. As rates rise, interest costs explode. As interest costs explode, deficits grow. As deficits grow, more borrowing is required. As more borrowing is required, rates rise further. This is not a cycle that can be reformed away. It is a trap, and the only way out is a reset. A reset requires capital, trillions of dollars in capital. Where will it come from? Not from taxes. The public will not accept austerity on that scale, not from foreign creditors. China and Japan are already reducing their treasury holdings, not from the Federal Reserve. Another round of quantitative easing would trigger runaway inflation. The only source of capital large enough to plug a multi-trillion-dollar hole is the $17 trillion sitting in U.S. bank deposits. That is your savings, that is your liquidity, and that is the target. The trigger is already forming. The yield curve has been inverted for over a year. Every single recession in modern history has been preceded by an inverted yield curve. This is not correlation, it is causation. An inverted curve signals that the bond market expects economic contraction, and contraction exposes the weaknesses in an over-leveraged system. Commercial real estate is collapsing. Office buildings in major cities are worth 40% less than their mortgage values. Regional banks are sitting on billions in unrealized losses. The Federal Reserve's own data shows that banks are holding securities that, if marked to market, would wipe out their capital reserves. This is not speculation. This is their balance sheet. The system is insolvent. It is being held together by accounting tricks and emergency lending facilities. But accounting tricks do not stop bank runs. And the next bank run will not be slow. It will be digital. It will be instantaneous. And it will spread across the entire system in hours. When that happens, the government will not have the capacity to execute a 2008-style bailout. The political will does not exist. The fiscal space does not exist. The only option will be a bail-in, and the infrastructure to execute it is already live. On the 20th of July 2023, the Federal Reserve launched the FedNow service. It was marketed to the public as an instant payment system, a modernization of the banking infrastructure that would allow real-time transfers between accounts. The media coverage was minimal, the public barely noticed, but FedNow is not a payment upgrade. It is the technological foundation for a central bank digital currency, and it is the mechanism through which a bail-in will be executed. Here is what FedNow actually does. It creates a direct, real-time connection between the Federal Reserve and every bank account in the United States. Previously, payments moved through intermediaries, through correspondent banks and clearinghouses. There were delays, friction, points of independence. FedNow eliminates all of that. It gives the Federal Reserve instantaneous access to the entire banking system. This is not about convenience. This is about control. The moment FedNow went live, the central bank gained the ability to freeze, redirect, or confiscate funds across the entire nation with a single command. This is the infrastructure for a digital dollar, and a digital dollar is not cash. Cash is anonymous, physical, and outside the system. A digital dollar is traceable, programmable, and controlled. The Bank for International Settlements has published multiple papers describing the features of a CBDC. They include spending limits, velocity mandates, expiration dates, and geographic restrictions. Your money will not be yours. It will be a conditional license to transact, subject to rules that can be changed at any time. And the transition to this system will not be voluntary. It will be forced. It will happen during a crisis. And it will happen faster than you can react. Let me walk you through exactly how the bail-in will unfold. It will begin on a Friday evening. A major bank or a network of regional banks will announce that they are insolvent, the stock will be halted, the news will spread through financial media. By Saturday morning, global markets will be in freefall. Emergency meetings will be convened at the Treasury, the Federal Reserve, and the FDIC. The phrase systemic risk will be repeated in every statement. By Saturday afternoon, the President will invoke the Systemic Risk Exception Clause buried in Dodd-Frank Title II. This clause allows the FDIC and Treasury to override standard resolution procedures in the event of a threat to financial stability. It requires approval from 2/3 of the Federal Reserve Board, 2/3 of the FDIC Board, and the Treasury Secretary in consultation with the President. This approval will be granted within hours. By Sunday morning, a bank holiday will be declared. All banks will close. All ATMs will be disabled. All electronic transfers will be frozen. The public will be told this is temporary, a brief pause to stabilize the system. It will not be temporary. While the nation is locked out of its accounts, a software protocol will execute across the FedNow network. This protocol, pre-programmed and tested, will scan every account in the system. It will calculate a percentage of each deposit to be converted. The percentage will depend on the size of the hole in the banking system. It could be 20%, it could be 50%. The algorithm will determine the number required to recapitalize the failing institutions. On Monday morning, Americans will wake to find their bank accounts reopened. But the balances will be different. A portion of every deposit will have been converted, not stolen. Converted. Converted into a new instrument, a central bank digital currency, a Fed-issued digital dollar. You will see a balance in your account. But when you try to withdraw it, you will discover the new rules. There will be daily withdrawal limits. There will be restrictions on transfers to foreign accounts. There will be categories of approved spending. And there will be expiration dates. Money that is not spent within a certain period will lose value or disappear entirely. This is not fiction. This is the stated purpose of a CBDC, according to central bank research papers. They call it increasing monetary velocity. It means forcing you to spend. Your liquidity, your freedom to save, your ability to opt out, all of it will be gone. And it will have been done legally, under laws that were passed more than a decade ago, using infrastructure that was built in plain sight. Now let me show you who already knows this is coming. Since 2022, central banks around the world have been buying physical gold at the fastest pace ever recorded. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2022 and again in 2023. This is not normal. For decades, central banks were net sellers of gold. They called it a barbarous relic. They told the public that paper assets and digital ledgers were the future. But their actions tell a different story. They are moving wealth out of the digital system and into physical assets that cannot be confiscated by software. They are repatriating gold reserves, moving bars out of the Federal Reserve Bank of New York and the Bank of England back into domestic vaults where they have full control. Why? Because they know that in the system they are building, gold will be the only asset beyond the reach of programmable money. Corporate insiders are following the same playbook. Cash positions at major corporations are being liquidated. Excess liquidity is being deployed into hard assets. Farmland, timberland, infrastructure, real estate, fine art. These are assets that exist in the physical world, that cannot be diluted by a keystroke, that cannot be frozen by a protocol. The wealthy are building an ark. They are moving their wealth out of the financial system and into the real economy. And they are doing it quietly, before the public realizes what is happening. This is not paranoia. This is observable behavior. When the people who make the rules start playing by different rules, you should pay attention. The first test of the bail-in system will come soon. I predict that between the first and third quarters of 2025, a significant regional bank, or possibly a smaller European bank, will fail. The failure will be sudden but not chaotic. Regulators will step in immediately. And for the first time in the United States, they will deploy the single point of entry resolution. A portion of uninsured deposits, perhaps 10 or 20%, will be converted into equity or a restricted digital certificate. The media will praise the swift action. They will highlight that no taxpayer money was used. They will call it innovative, responsible, a model for the future. The public will barely notice. Most people do not have uninsured deposits above the FDIC limit. They will assume it does not affect them. But this is the normalization phase. This is the beta test. The system is being stress tested on a small scale so that when the real crisis arrives, the mechanics are already familiar, the legal precedent is set, and the public has been conditioned to accept it. The real event will come between the fourth quarter of 2025 and the second quarter of 2026. A black swan will strike. It could be a failed treasury auction. It could be a cascading default in commercial real estate. It could be a geopolitical shock that freezes credit markets. The specific trigger does not matter. What matters is that the system is so fragile, so over-leveraged, so interconnected that any shock will cascade. The interbank lending market will freeze. Liquidity will evaporate. Counterparty risk will paralyze the system. And this time, the contagion will spread faster than in 2008 because the system is more complex, more algorithmic, and more fragile. High-frequency trading will amplify the panic, derivative exposures will multiply the losses, and the Federal Reserve will be out of ammunition. Interest rates are already elevated, the balance sheet is already bloated. There is no room for another round of emergency intervention without triggering a currency crisis. The only option will be the bail-in. The systemic risk exception will be invoked, the 72-hour protocol will execute, and the largest wealth transfer in human history will occur over a single weekend. When Monday arrives and the system reopens, the crisis will be declared over. The banks will be recapitalized. The officials will appear on television and explain that the extreme measures were necessary to preserve stability. They will frame it as a success. They will say that the system was saved. And technically, they will be correct. The system will have been saved, but you will have paid for it. Your savings will have been converted into a programmable digital currency that you do not control. The US dollar as you know it, as physical cash, as a bearer instrument, will be phased out. It will be replaced by a CBDC, a central bank liability that exists only as an entry in a government database. Every transaction you make will be visible. Every purchase will be recorded. Every transfer will be analyzed. Financial privacy will become a relic of the past, and your net worth will no longer be private property. It will be a variable in a policy equation, subject to adjustment based on the needs of the state. This is not the first time a government has confiscated private wealth to survive a crisis. History is filled with examples. In 1933, President Franklin Roosevelt signed Executive Order 6102, which made it illegal for American citizens to own gold. All gold coins, bullion, and certificates had to be surrendered to the Federal Reserve at a fixed price of $20.67 per ounce. Those who refused faced fines of $10,000 and up to 10 years in prison. After the confiscation was complete, the government revalued gold to $35 per ounce, effectively devaluing the dollar and transferring wealth from private citizens to the state. In Weimar Germany, the government inflated the currency to pay war debts, destroying the savings of the middle class overnight. In revolutionary France, the assignat currency was printed into worthlessness, wiping out generations of accumulated wealth. In Zimbabwe, hyperinflation reduced the currency to paper. In each case, the mechanism was different, but the pattern was the same. When a government faces insolvency, it does not collapse quietly. It takes what it needs. It confiscates wealth, it devalues currency, it rewrites the rules. The only variable is the sophistication of the tools available. In 1933, they used executive orders and physical confiscation. Today, they have digital infrastructure, instant access, and legal frameworks already in place. The technology is perfect. The laws are written. The protocol is active. All that remains is the crisis. So let me bring you back to where we started. The FDIC document, the single point of entry strategy, the paradox of a Federal Reserve that insists the system is stable while simultaneously building a replacement, the template provided by Cyprus, where depositors were converted into creditors overnight. This is not a conspiracy theory. This is not speculation. This is infrastructure. The Dodd-Frank Act legalized bail-ins in 2010. The FedNow system went live in 2023. The CBDC blueprints have been published by the Bank for International Settlements. Central banks are buying gold at record levels. Corporate insiders are moving into hard assets. The timeline is forming. The beta test is coming. And the event will follow. The uncomfortable truth is this. The system is not designed to protect you. It is designed to survive. And when survival requires your savings, the system will take them. It will do so legally, it will do so instantly, and it will do so in a way that makes resistance impossible. Those who dismiss this as alarmism will be the first to lose everything because they will be the least prepared. Those who understand the pattern, who see the infrastructure, who recognize the historical inevitability, have a narrow window to act. That window is closing. When the protocol activates, when your account is frozen over a weekend and your savings are converted into programmable digital tokens controlled by the state, will you remember this moment? Will you remember that you were warned? Or will you, like the citizens of Cyprus, simply wake up one morning and discover that the money you thought was yours never was?